I am honored to invite my our first speaker today, Mr. Anish Teli. He's the founder of QED Capital, and before that he has had senior positions at equity funds managed by SSI Ventures, Morgan Stanley Private Equity Asia. He's also co-authored two papers on factor investing. One is called Long Factors, Not Short Change, and the other one is long only factor portfolios in India. And the other one paper is called the Conservative Formula, Evidence from India. So I personally know Anish, for many years. I think if there is maybe a top three, top five people in India who understands factors in a very deep way, I think it would be Anish. He's an absolute expert. I've shared Twitter Spaces, and I've done Clubhouse conversations with him, and I'm also an avid reader of his newsletter that I think he has one or two emails that go out every month. So I'm a big fan of Anish, and hopefully we'll be able to learn a lot from his experience in factor investing in India, and what he can sort of bring on table in terms of how we can answer some of the questions that investors may have, especially about quality and value, which are the two factors in discussion today. So with that, Anish, I think you're already online. So I think over to you, Anish. Sorry, and just to add in, we'll also have a Q&A session, for this conversation. To all the viewers out there, please do put your comments in the comment section, and Shankar, who's also part of our fund management team at Motilal Oswal Asset Management, will be able to pick it up and ask Anish and other speakers that are speaking today. So with that, over to you, Anish.
Hi, Pratik. Thanks for your very kind words in introduction. I think it's, we, like you rightly said, we've shared a number of Twitter Spaces, Clubhouses, and we've interacted quite a bit. And, it's very nice to see a large fund house like yours pioneering these efforts in building factor investing as an approach in India. Like you said, the early days, but sometimes like we've seen in index funds, sometimes we sidestep a number of years and just jump straight into some of these adoption rates can be much faster than we sometimes think they would be. So I think we're with Alpha really in the large cap and even in other active categories under pressure. I think that factor funds will be one big growth area going forward. So with that, let me just jump right into the presentation for today. So I'm just going to keep it run it through 3-4 slides and key slides, and I have a lot more, but we'll reserve that for Q&A. We want to make it as interactive as possible. So let me just. Yeah. I think you can see the slide. So the factor I'm going to talk about today is quality, and it's one of the more robust factors as we'll see going forward. This is a little bit about us. We are a SEBI-registered PMS, and we focus on factor-based investing. That's been our approach since day one. Let me just jump right into. I know this is our second session, so you guys are familiar with what is factor-based investing and what are factors. But just a quick preview here that factor investing takes the best of, I think, passive investing, where it has a lower fee, a diversified portfolio, and it also has the potential for outperformance, which it takes from active investing. And it sort of tends to eliminate bias and emotions when it comes to execution. So it helps you to tilt an index, or it is nothing but an investing style which you will see in active investing. But the parameters here are fairly clear and codified, and the way it's done is very clear. So what are factors? You guys already know that there are a set of characteristics which are common across a broad set of securities. The most robust and accepted factors today are momentum, value, size, quality, and low vol. And the reasons why factors work, a lot of people ask, why do factors work if everybody knows everything about the factors? Uh, so there is one of the reasons why they work is there is a risk premium that's attached to that. So you are taking some risk, and I'll go into more detail about what that risk could be. That risk is different for different factors. And then there are some behavioral, reasons why it exists. Our focus factors actually are momentum, low vol, and quality. Those are the three that we focus on. And the latest paper that Pratik mentioned, the conservative formula, we've implemented using these three factors. So why does factor investing work? So the rule number one, factor in if you accept rule number one that factor investing works, then we have a whole lot of data and actual track record to show that to you. Rule number two is that factor investing does not work all the time. It works, but it does not work all the time. And rule number two is the reason that rule number one is actually that it's possible that factor investing works. It works over cycles, it works over time, but it does not work all the time. And there is some pain. Just remember that there is no premium without any pain. So there is some pain that you will take in when you implement a factor-based strategy or any active strategy, which because if you are going to earn an extra premium, there is a certain reason why that premium exists or has not been arbitraged away. So that is something that you will have to bear in mind, and that also gives you confidence that this factor is not going to go away. It's going to if it's been around for over 50, 100 years, it's going to be around for the next 50 to 100 years. Getting into quality, we the paper that Pratik mentioned again, long factors, not short change, which I wrote with my co-author Rajan. So where we defined the quality as we took it from one of the factor indices by the index providers, and it's most commonly taken as a quality. Is either a profitability number or it's an ROE number, or it's a leverage number. One of the two or three numbers are taken, and those so high ROE companies or companies with low leverage, companies with low EPS growth variability, those kind of companies tend to be defined as quality companies, or companies with high gross profitability tend to be defined as quality companies. So what did we find? We found that also that quality tends to have a large cap bias. It also has a much lower turnover as compared to momentum, but almost similar to low volatility. And it falls under the top two performing factors that we found over a 15-year period. On a rolling period, it had it's number two in place behind momentum, but if you factor in the implementation costs that we take, it's almost as good as quality. It's almost as good as momentum. Sorry. So so quality has been a fairly good performer in the last 10 to 15 years. Again, one of the reasons one of the factors we know that has not done too well has been value. But that is the pain that we take, that the next 10 years could belong to value. That's fairly possible. Factors can have fairly long periods of underperformance or low performance as we speak. This is another one from our paper. So we showed that there is a large cap bias, which I mentioned. And most of the companies in the quality basket portfolio came from FMCGs, which are consumer non-cyclical, and financials in India. So that's what we found for India. Now, why does the quality factor premium exist? What is the reason that people why isn't that people, everybody knows, right, that high ROE companies are going to do well, high growth companies are going to do well, companies which have less variability in their earning growth are going to do well. So why has this premium not been arbitraged away? One of the most common reasons is that academic factors are long short portfolios, whereas most of the time we implement these in long only form. So ETFs or mutual funds are a long only product. We are only buying, we are not shorting on the other side. So that's one of the reasons also that it's not completely arbitrage away. But the main reason that factor premium exists, one is the risk premium. So the risk argument for quality, I'll state up front, is a little bit weaker than the behavioral argument. The risk premium argument says that quality stocks also tend to be growth stocks, and most of their value lies in future cash flows. And those future cash flows, there can be variability in their actual realization. So there, when you are investing in a quality stock, this is the risk you're taking, whether those future cash flows will pan out as expected. The second and more we think the more robust reason why uh, quality factor exists is the behavioral reason that investors tend to underestimate mean reversion. This happens in momentum also. This happens but in a different way. But in quality, it happens in the way that people assume that okay, we've got 3 or 4 years of good performance, and now the company is going to mean revert, or that there are companies on the other end of the spectrum, what AQR describes as junk. So they have a factor called quality minus junk. So quality at one end and junk at the other end. So investors tend to buy some of those junk companies, thinking that the numbers are the worst is over, and the numbers are going to now mean revert. The profitability numbers or the profitability parameters, ROE, gross profitability, things like that, they will revert back to trend. But it's an underestimation, and that leads to mispricing. And therein lies the crux of why these factors sort of, at least the quality factor premium exists. So, like I already mentioned, the behavioral reason is stronger for quality than the risk premium argument. For value, I think it's the other way around. For momentum, again, it's the behavioral reason. We also looked at performance across business cycles. So we've seen that in contraction periods, again, that which we've experienced in the past period, that quality tends to perform. It loses much less. You can see it was down about 3.2% in contraction periods, whereas momentum was down about that much. Small caps, which is the size, was down a lot more. It was down 19% in contraction periods. So whereas it's done the same as quality in an expansion period. So it protects a lot of downside when things are bad. So it's one of the more robust factors out there. Again, this is the same chart in a graphical form. You can see that in most expansion as well as contraction periods, quality is in the top 3 factors in terms of performance. However, in the last cycle that we've seen post-COVID, post the vaccine coming, value has made a very strong comeback, and maybe the next 5 to 10 years, maybe where we'll see value do extremely well. But we are data driven, so we are going to be just looking at the data. So this is again the same thing that during contraction periods, you can see that quality has been one of the consistent entrance in the top 3 numbers. And even in this one, while we've kept it blank because we think this contraction period is going to get over very soon, but we think that it's going to be low wall quality that will be in the top 2 or 3 that will be there. This is an interesting paper for those who want to read about Warren Buffett. He's actually, AQR has written a paper called Buffett Alpha, where they say that Buffett's returns are not luck or magic, but reward for leveraging cheap, safe quality stocks. So as usual, Buffett knew a lot of things before the academics or other practitioners knew about the low volatility and quality. And these are just the extracts from the 3 papers that we have. I think we put the links there, and you'll get it after the presentation. Maybe the event organizers will send it to you. While let me just end with this quote that, while factor investing looks very simple in terms of the parameters and in terms of the execution, let me tell you that and one of the stronger reasons why it exists is the behavioral reason, and that is why it is very hard to stick to those when times are tough, like we've seen in the last year or so. So that's more or less from me, and over to you, Shankar.
Hey, thanks, Anish. That was extremely insightful, and I actually prepared a set of questions, but you seem to have covered quite a few of those. So I have to, try to do it on the fly here.
Yeah.
But okay, so maybe one of the first questions, when which something which I get asked a lot, but wanted to get your perspective as well on this, is a lot of times uh, investors tend to feel or get a feeling that factors in general tend to look great in backtest, but once you actually start deploying capital and once you start investing money in them, some of the returns or most of the returns vanish, and what you end up with is just market returns, or pre-fees, and post-fees is less than market returns. So what do you have to say to that? And specifically with respect to the quality factor, have you seen any evidence of quality factor premium going down after the factor was introduced and so on?
So, Shankar, that fear is not unfounded, because it is, that it's a new phenomenon as such in India, and it's been preceded perhaps by a number of back-tested strategies, and somehow it falls under that bracket of back-tested strategies. But factor investing has a very long history, not just in US, but even in Europe and globally. Something like momentum has almost a 200-year history, and it's been around. So there is a lot of out of sample, uh, you know, data for that. And sometimes in implementation, it is there is some art. There is what AQR calls craftsmanship alpha. That the way you combine factors or the way you use factors, it's very easy to, like. I could say the same for a DCF, right? You tweak some of the numbers, and the DCF looks really, really nice. You change the terminal value, you change the interest rates, and it looks nice. So yes, if you want to, you can tweak it. But I think now in India, I think that question should be settled, because the NSE and the other index providers have been giving live data now on indexes for the last 10 years or so. And yeah, when it comes to implementation, it's been probably 3 or 4 years. I think the momentum index has done pretty well after launch. Quality has done also well in line with expectations. And I think as the time goes by, there is no substitute for live data. So I think as time goes by, and people get that live performance, yes, there can be, and the tracking errors are sort of, they come down. I think we will see that question being settled. The same was asked of index funds also earlier, but I think that question has been settled now. So I think hopefully for factor funds also, I think I'm pretty confident that question will be settled.
Great. And actually, that leads me into a segue into the next question, which I had to ask, which is one of the things you mentioned, which is how long of data should be considered long enough to really start believing or start making all the naysayers into converting them into believers? So is it 1 year, 3 years, or are we talking about 10 years?
No, I think you need much longer periods, I would say, more than in terms of if you are looking at past data, I would say that at least look at I think in India we do get decent data from 2005 onwards. So we have 17 years of data now, which is pretty long. And if that data is presented properly and correctly, I think that is good enough. And what we can do is compare that along with implementations of similar factors with other markets and see the performance there. Then consider liquidity, consider some of the other implementation challenges that we have in India, which is why in our paper also, we stuck to the liquid end of the market. We answered that question there. That if even if we stick, because people, one of the most questions that get asked is that these premiums exist at the lower end of the market, where small caps or in micro caps. So how are you going to be able? Is there capacity for this strategy or not? Is there capacity for this factor or not? Right. And that's the question that we answered. Because we took the top 200 companies by market cap. So there is capacity, there is implementability, there is a fair amount of good data out there. So I think if you have 10 to 15 years of data and compare it to performance with markets that have much longer periods, I think that's good enough to begin with.
Right. And very interesting that you mentioned the point on craftsmanship. But sticking to index funds just for the interest of this particular conclave, even within the index fund, unlike let's say a value fund or a momentum fund, where there seems to be a lot of homogeneity with respect to how the factors are really measured, when it comes to quality, a different index provider tends to have a different methodology. So do you get are you of the opinion that irrespective of the methodology, the broader aspects need to be captured, or do you think the devil really lies in the details?
A good question. So I would say that when it comes to factors that use accounting data, you have to be a little careful, because that can so that is one of the reasons I like low vol momentum, because it's price. At the end of the day, price is your and even something like value, where you're taking price to sales, price to book. You're not complicating it too much. So the same thing, the original guys, the Pharma and French, use gross profitability, and they think that is a much more robust number to use than EPS. But I think irrespective of the number that you or the of the parameter that you use, perhaps to make it robust, you can use 2 or 3 factors, so that if there is some difference, you can cancel it. When I say factors, parameters within the factors to define the factor. For example, quality you can take. So in the paper we took ROE, debt to leverage, and one more other factor. That EPS variability is the factor we took, is the parameter we took. So you can add gross profitability, you can add that and equal weight it again, because then the more parameters you use, the more fragility you also introduce in the system, and then more number of choices you have to make. So it's really sometimes an interesting thing that we found in the conservative formula, which uses 3 factors, which is low vol, momentum, and value. But the parameter that it uses for value in global markets, which is dividend yield, turns out to be quality in India. Because when we regressed it was found to give exposure to the quality factor more than the value factor. So sometimes the same parameter can have different meanings, or be giving different exposures in different markets. So that is something that you need to go back and test. I think my co-author Rajan, I think he's on the call. And even the professors from IMA, J.R. Verma and Sobesh Agarwal, they maintain a database of the Pharma French factors. So I think if we use those as a benchmark and regress use those as to determine whether is this factor if this strategy giving me the exposure that I'm looking for. In the paper we also looked at a factor exposure calculation that we've done. So there are ways to sort of check that when we sort of implement. So I think that's a good way to check, and maybe use, like I said, 2 or 3 parameters, equal weight them. I think that should be good enough.
Great. So Okay, so a slightly different question is, are you from the camp that believes? So you actually mentioned in your presentation that factors, or especially the quality factor, tends to do well when you are in an economic contraction kind of a regime. I could maybe extend that to say maybe they do better when market is correcting or it's crashing, as opposed to when we are in a raging bull market.
Yeah.
So if that is the hypothesis, are you of the camp which believes that factors can be timed or the quality factor can be timed? Or are you of the camp which feels that that's absolute harakiri and you should never resort to it? Or are you somewhere in between?
So, again, I'll go back to my favorite quant, Cliff Asness, who says, if you must sin a little. If you want to time a little, uh, maybe use the value spreads, maybe use even momentum. There is factor momentum in among factors. So
Right.
there is some amount of that. But on as a whole, I would say if you are a full-time investor, if you are a DIY investor, I think probably you can do that. And as the market grows, perhaps you can have a rotation fund which sort of does that. But at this point in time, I would say just take exposure to the 3 or 4 top factors and don't maybe rebalance them over a period of time. Don't time them too much. Uh, because it is very tough, and I'm not sure whether the outperformance that you will get by trying to time them uh, will be high enough. But at the same time, I would say I've not made up my mind. I am working on that. Actually, that's one of the questions I do talk to Rajan a lot about, and we discuss that a lot, and we've done some work on that. So maybe hopefully in the next year or so we should maybe come up with some more answers on that issue.
All right, very interesting. So do you, I'm sure there are certain periods where the quality factor does not do so well. So if you could highlight some of those periods where you expect the quality factor prima facie to not do so great. And also, an adjoining question to that is, do you see any problem? So if you just look at the portfolio of high quality, any index that's out there, mostly you'll see companies that belong to FMCG, maybe 30-40% of the index
Yeah.
is comprised of that. And most of these trade at very high multiples. Now, there's a
Yeah.
question as to whether those multiples are high compared to their history, relative to where they were trading at earlier, relative to their sector. I am not talking about that, but in general, you would expect them to trade at a much higher valuation. So, do you see any risks, or foresee any risks with investing in these kind of companies? Especially because one of the things which you also mentioned, and I think we've also observed, is the quality factor tends to do well in market downturns. So,
Yeah.
is it a good idea? So, keeping the behavioral part aside, is it a good idea to be entering into a market downturn with extremely high starting valuations? That's the one. That's the first question. Maybe the second question is, when do you think the quality factor would underperform? Well, prima facie. So, yeah.
So yeah, I think the first question is the recent period that we've seen, right? Right from November 20 onwards, the value factor has done extremely well, and value has had a very long, time out, especially the long short value. The long only value has underperformed. It's not done so bad, but post vaccine, when we had the reopening trade and economic sensitive stocks sort of rebounded. Even now, some of the stocks that have done extremely well have been from cyclical sectors, which tend to be again exposed to the value factor tends to be exposed to. So in these kind of periods, you will see that the value factor does much better than the quality factor. And starting valuations, will play some amount of role definitely, because there will be some amount of mean reversion in that. And and like I said, like the value factor has its time out over the last 5 to 10 years. It could be the turn of quality in the next 5 years. We don't know, right? Maybe we would. If there's been underinvestment in oil companies, for example, or in refining and petroleum, and if a lot of investments are going to go there, and cyclicals and capex driven companies do well in the next 5 to 10 years, I think we'll see a lot of value outperform quality, because that's when the animal spirits are alive. That's when a lot of people will go for these economic sensitive, lot of capital formation will take place. And so the 2000 to 2010 period is when a company like HUL did not do too well, which would be considered a quality company, and in the next 10 years it's performed extremely well. So again, it could be one of those, we are at the cusp or that inflection point of one of those cycles, very long regime changes, where we could see value outperform quality, but we never know. So it's always better to be diversified. If you're investing for the long 10, 15, 20 years, just diversify among factors.
Great. So I think that leads me to the last question which I have for you, which is, given the uncertainty with respect to any factor, not just the quality factor, and there could what you just said could very well play out, right? For the next 5-10 years, you may see a value rotation into the capital intensive sector as against the FMCG segment. So what is a good diversification idea? Do you diversify value quality, or do you diversify value quality momentum? What are your thoughts on that?
So again, there we found that value and momentum tend to be the least correlated, right? Not just among long short, but even in the long only category. So if you want to sort of have a lot, the best diversification, you say just do value momentum. But I would say that add some amount of quality, some amount of low volatility along with that. So I think that's broadly it. But no one knows what's going to happen again in the next 5 to 10 years. But these two factors, I think data is there to back it up, not in India as well as globally, that value and momentum tend to be, and even it's very interesting, value has a very strong risk premium argument, momentum has a very strong behavioral argument. So you also diversify among the reasons and explanations why it works, and it sort of protects you against what kind of a market regime you are in. If it's a very valuation sensitive market regime that you are in, then value will tend to do extremely well. If you're in a very momentum liquidity driven kind of market regime, momentum stocks will, with higher rebalancing, because the frequency of rebalancing is higher in momentum, so you will tend to capture factor rotation or sector rotation very fast. So I call momentum as a chameleon factor, that it's a chameleon, it changes colors really fast, and you can sort of take advantage of that. And value has a very slow rebalancing, at least a year, 6 months to a year. So even that way, in terms of the implementation style, it's a good diversification. Same goes for quality. Quality also, the turnover is fairly low. But yeah, valuations are a concern in the quality phase. So but things can go on longer than we expect.
All right. Great. Thanks, Anish. I want to have one more question for you. It's like let's say a spurious question, but do you think the quality factor has lived up to its expectation in the last 1 year or so? Especially given the uncertainty in the first half of this year, do you think the quality factor was true to label or not so much? Or maybe it was in two halves. What are your thoughts on that?
I think the last 1 year it's been true to label. If you had a diversified portfolio of quality companies, not concentrated, if you had a diversified portfolio, I think those have not done too badly. They have not fallen that much. So they have been true to label, I would say. That and even we track quality all factors on a weekly basis. So in the last 2 to 3 months, quality has been one of the stronger factors in terms of performance on a monthly basis. So we've seen some amount of rotation when metals and energy take a hit, which is when the value factor took a hit. FMCG slowly came and took its place and sort of provided the bulwark in your portfolio. So I think they've, in the last 3 to 6 months, they have been true to label and given you that that confidence or at least lower volatility in your portfolio during a very uncertain and a very turbulent time.
Great. Thanks, Anish. That was very, very insightful, very, very
Thanks,
helpful.
Ankur.
Thanks for taking the time. Great having you here.
Thanks for inviting. Thanks for inviting. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.